much, Kyle. I'm Chris Lawton. I'm Director of Knowledge Exchange here at Farm Credit East, and I am pleased to introduce Mr. Zach Harding. He is a Profit Center Manager at the Andersons. He began his career as a merchandiser with the Lansing Trade Group in Kansas. His training took him all over the country, trading various grains all over the nation. He then moved on to the Andersons, where he joined the Northeast Grains team as a merchant. And in 2020, he took over as Profit Center Manager and currently leads a team of 7. He strives to add value to producers and end users within the ag supply chain through insights, a variety of options, and trusted relationships. He currently lives in Kansas. If I could add the disclaimer, just that we're going to be talking about various commodity markets and that sort of thing, and the information is presented in good faith but without warranty. So with that, I will turn it over to Zach and let him give us his, one other thing is that this webinar is being recorded, and the recording will be available at our webinars page, which is farmcrediteast.com/webinars. And it should be posted within 24 hours. With that, I will turn it over to Zach and let him present the grain market outlook.
Okay.
So we are seeing the editing side of PowerPoint.
Okay, so this is the screen?
Yep.
Okay.
And then if you go up to your display settings there on that, where it has your 2 slides on it, it'll be on the top bar there. Display settings, one over, yep. And then just do swap presenter view and slideshow.
Thank you, Kyle.
Perfect.
For helping me there. Okay, we ready to go?
Yep, you're all set to go.
Excellent. Well, thank you so much for the introduction, guys. It's an honor to be here. I get really excited to get a chance to talk about the markets with participants in the market, especially around where I trade in the Northeast. So again, appreciate the opportunity to be here. We'll go ahead and get started. Thanks, Chris, for the introduction. I added a slide in here too. Just a little background on myself. I work for the Andersons as the Profit Center Manager of our Northeast grain business. We primarily trade corn, soybeans, and wheat, some other small grains as well, oats, barley, sorghum, and rye as the market kind of dictates. We focus on New York and Pennsylvania, but we also touch a handful of other states in the Mid-Atlantic and Northeast regions, as well as Ontario and Quebec into Canada. The majority of our product is moved, probably 85% is moved by truck transportation, but we are involved in rail markets and newly involved in some vessel markets utilizing the Port of Oswego in New York. I have 13 years of merchandising experience. I've traded anywhere from the Midwest in grains, export containers, ethanol and fuels, and obviously in the Northeast. I came out of Penn State in '09. I'm originally from the East Coast with the agribusiness degree. I grew up on a small cow-calf beef operation in central Pennsylvania, 7th generation of that farm. My parents still live there today. And I currently live in Overland Park, Kansas with my wife, Katie, my daughter, Ada, and my son, Hank, who just turned 8 months yesterday. So. As far as the agenda today, I wanted to run through just a few things. The 2021 year in review, I have that in quotes because as we look at some charts here, we look back kind of a 3-year view and really try to evaluate in the context of COVID and the pandemic and what that's done to the markets. We'll go over the January WASDE, dissect the pieces of that and the effects on the market going forward. South American prospects, both some historical production numbers, what they're doing this year, and some potential numbers that we can see from them going forward. Lastly, biofuels, we'll hit on the normal suspects there, ethanol, but also on some new biofuels, renewable diesel, and sustainable aviation fuel. And then we'll wrap it up with kind of a forward-looking update for 2022 and into 2023. Hopefully we'll have some time for questions and answers at the end, but feel free to interrupt, ask questions at any time as we go here. I think Kyle did put in the chat. We do have a chat box for questions, so feel free to dump them in there as well. With that, we'll go ahead and get started. So this is the DEES 2021 corn chart, which extends all the way back to December of 2019. So you have basically 3 crop years here on this chart, and they're separated by the red lines. And Kyle, let me know if you can see my laser pointer. These red lines?
Yes, we can.
Excellent. Okay. Those are the crop years. So that's September to September. So we started into the end of December into January 2021, generally low price, depressed price environment. You know, for the last 4 or 5 years, margin structures had been relatively break even, nothing great in corn, or to the export side, nothing really fantastic. So we've been in a kind of looking for demand mode, and then we got hit by COVID. And so all of a sudden, there's extreme concern, a lot of pessimism in the market. Where is the demand going to come from? And so we fade off into those lows into April and May, and really stay there through the beginning of the COVID pandemic, with so much uncertainty of what's going to happen and where this demand is going to come from. From there, we get into the fall. Our harvest, our crop is realized, and China sees an opportunity to restock some of their supplies, and they start to buy. And we just don't have the infrastructure ability to get it there. So here comes the demand, and we didn't have the product in the pipeline to get it to them, and that fed on itself and fed on itself until you see the highs in May of 2021. What does 638 corn do for the following year? It encourages incredible amounts of production. And we'll walk through these numbers when we get to the WASDE report, but we're going to plant a pile of acres in May and June, and those acres go in, and seasonally the market is going to tail off as that crop grows and the weather premium disintegrates, and we get into October lows over here, September lows over here, which is a normal seasonal turning point. And now this grain has to get to market again, and all of a sudden we have inflation fears. We have input fears, inputs, chemicals, everything is labor's through the roof. So are we in a new environment where you can't plant corn for less than $5? So that's the move higher here at the end. And that's kind of this overview that I've been taking, trying to look at what's corn been doing. I really think you have to look at it as a function of these 3 crop years and how each one kind of built on each other to get us to the situation that we're in now. Similar to soybeans, you had the 826 low in May, and nothing really exciting from the demand standpoint. China saw a huge opportunity to buy cheap grain. They came in and started snatching it up, and we just couldn't get it to them fast enough. Obviously, all you heard for the last year and a half, supply chain issue, getting goods to the destinations, and this was really the heart of the demand-driven story that we saw. This was not a supply-driven story. We have plenty of product, we just were not able to get it to the destinations. Similar to corn, when you get to 1480 highs, you're going to plant a pile of beans. We'll see that later. The beans grow, you tail off seasonally into October. Unfortunately, with this chart, this is November 21 soybeans. So unfortunately, with this chart, you don't get to see the last 4 months of what happened. We traded today at 15.90. So there's another $3 of upside, $3.50 of upside from where this chart is out to today. So that secondary part, the inputs, higher price environment, inflation, that has led us to this next leg higher, kind of over this 3-year period. I'm gonna jump right into the WASDE here. So this is your corn supply and demand in the U.S. Again, separated by 3 crop years with the red dotted lines there. I have some boxes to help us kind of illustrate the story as we walk through here. So the first thing we want to start on is ending stocks in 2019-20. You had 1.9 billion, nearly 2 billion bushels of corn, plenty of corn around. And as illustrated on the last chart at the beginning of end of 19, early 20, where 350, 325 corn was kind of the story. Fast forward to the following year, you're not going to plant a lot more acres. We have 14 billion bushels of corn as production seems to be comfortable, but all of a sudden here comes China, 1.7 to 2.7 on the export front, and we're like, uh-oh, here comes ethanol gas demand faster than we expected, 4.8 to 5.2. And now we're sitting here with a 1.2 carryout, 1.2 billion. We went from nearly 2 billion to 1.2 billion in a year, and we were flirting with less than a billion, with some of these demand numbers potentially being over 3 billion here in exports and 5.2 in ethanol. So we flirted with under 1 billion bushels carry out in a year. And again, you can see this clearly on the chart as we weren't able to get this to destination, then the demand was there and they wanted it. So fast forward another year, you saw the high prices. What are we going to do? We're going to plant a pile of acres, right? 93.4 million corn acres. I think we planted closer to 95. You got a big yield, 177, 15 billion bushel production. Go from 14 to 15 billion production year over year. Incredible increase in production. So should add some stability to the balance sheet and take some of this super rally, alleviate some of the rally we've had here. Well, ethanol demand is still very strong. We're going from 5 million to 5.3 million this year. And that just moved up from the last report. So this gas demand is very strong this year. The big thing you'll see both in corn and soybeans is we're not going to replicate last year's export program. We don't believe we have to, and we don't believe with South America's current production. We'll talk a lot more about that, but with South America's production, this 2.4 number sounds comfortable. Where does that leave us? At the end of this year, 1.54 billion. It's not 1.9, it's not 1.2, it's right in the middle. So we are at a breaking point here. Which way is this number going to trend as we work to the end of this crop year? Is this going to trend to 1.2 and we stay at elevated prices, or does this number trend closer to 1.9 and we reset markets back to $4.50, $4 somewhere in that range? Similar for soybeans. Actually going to go back a year before 1920, so 1819 would have had a 909, nearly 1 billion bushels in ending stocks. In that year, we ended with 525. That was a function of really low acres in the east. We had a very wet spring and we're not able to get in a significant portion of acres. So in hindsight, that aided a lot in dropping a very abundant, nearly billion bushel carryout in half down to 525. We get more return to more normal acres the following year. That Chinese demand is going to come. Obviously 1.6 to 2.2, incredible increase there. Drops your 525 to 257. So in basically 3 crop years, we've gone from nearly 1 billion to 250 million bushel carryout. And again, obviously illustrated in the futures market rally, and the demand is right here on the chart. You can see demand driving this. High prices, cure high prices. We're going to plant 87.2 million bean acres this year, 51 yield. We're going to have 4.4 billion production. What's going to go on with demand? Crush typically, 7 out of 10 years, is going to be higher than exports. So that's what we see here again. Crush is a slight increase. We'll talk more about increases in crush longer term when we talk about biofuels, but crush still sturdy at 21.90. And exports, again, like we mentioned, not going to be able to execute the same program that we did last year. But this number is really in jeopardy with what's going on in South America and their weather down there. So we'll see. This number could certainly grow. Therefore, this number 350 could certainly shrink. Do we get closer to a 250 in a tighter market? It's certainly possible. But again, we don't know final Brazil yields, and we're not going to know those for a minute. So that's where we sit today on the U.S. soybean S&D. I'll take a quick breather there. Are there any questions from the group?
Not at this time, Zach. So why don't you keep rolling, and we'll hold any that come in for the conclusion of your presentation.
Okay, sounds good. So just some history on South America, 5-year history going back, combined Brazil and Argentina. As you can see, there's definitely stability on the right in the bean production, volatility in the corn production. You'll note kind of later in some of the other numbers, but with dual crop corn, 2 corn growing seasons in Brazil, you're going to see volatility based on a wide range of weather patterns across the size of that area down there. So definitely some volatility in the corn production. Soybeans considerably more stable, but the general trend here is they're increasing. So we are still growing production down in South America, and it looks like we will continue to do so. One thing I find extremely interesting about this chart is that, looks like it cut off some of my, cut off some of my chart here, but one thing that's really interesting is the yields in South America. So obviously with Brazil with 2 crops, you're not going to look at 160, 170 bushel yield, but their average yield over that 5 years is 83 bushel the acre. Argentina is better, 122, but the upside is incredible for these areas. As technology improves, seed technology and their infrastructure improves, to be able to capture the kind of yields that they can produce down there, I think the upside is really big in corn production and corn impact as you get down there. You know, another thing we note is for the longest time, investment in Brazil had been almost entirely at the port level. There was very little investment upriver or into the mid-continent. And where we see now is all of that investment into transportation systems into the mid-con, investments in the mid-con, and robust systems to get them to and from. So I think that is really the next stage for Brazil to be able to compete in the world market in a more flexible manner. It allows them to switch between export and domestic opportunities much faster. Just a note on soybeans, they're pretty good at growing soybeans, 51.5 on an average yield. Not much more upside potential there. Just talk a little bit about Chinese soybean imports. Obviously, like I just said, port infrastructure down there was #1. They had to get these beans to the export market, and they knew it. So they built the infrastructure down there to do it. Before 2015-14, we were definitely the leader of exports of soybeans to China. There was no doubt about it. We started to compete 14, 15, 16, but then we started a trade war. And all of a sudden, China had to become incredibly reliant on South American beans. 17, 18, 19, almost all their beans are coming from Brazil. So as we look forward, it is incredibly important that the Brazil weather and their production is tied so closely to the margins in China. So Brazil is reliant on China's demand, and China is very reliant on Brazil's production. So the WASDE effect, what happened, you know, December versus January, what's different now versus what we thought before? And the 2 biggest takeaways here are these last 2 columns. The change from DEES and the change from 2021. So for corn, the changes were very minimal in the world report. Brazil was down 3 from the last report, Argentina up a little bit. World overall production down 1.7 million metric tons. That's on a 1.2 billion metric ton crop, right? So less than 1% move. Virtually no move in the change. Up 84 million metric tons from the year before. So down slightly from the last report. Expectations are very close, but we still have incredibly higher production in the world than last year. Over on the right side, Brazil, or I'm sorry, in soybeans, it was considerably more important. Brazil down 5, Argentina down 3 million metric tons, world down 9. So of the world being down 9, 8 of it comes from South America. That just ties to production. I think if you're looking at production, you have to turn around, take the demand side out of the equation and look at carry out, what's left over after all of the demand. And those are these 2 boxes here at the bottom. Again, in corn, we were down 2 million metric tons from the month before, but since last year, our carryout, what we have left over is actually up 10 million metric tons. We're more comfortable in our carryout this year than last year in the world. that we have plenty of corn. Soybeans is a different story. Soybeans dropped 6.8 million metric tons versus the last estimate and 5 from last year. And on a 100 million metric ton crop, that's significant. That's 5%. And actually, I just read the report. The WASDE for February came out about an hour ago, and this number dropped to 93, 92.5, 93. So that number continues to break. And that's the number that's really important, is what the effect is on carryout here. Production can go up and down, but if you don't add the demand piece to that equation, what you don't understand what the carryout looks like and what really is going to happen to the futures market. So just some key takeaways in the South American market. They experience virtually the same demand pulls that we do. It is crush veg oil and it is export to China. So when we look at our market versus their market, it's very simple to see who is more competitive based on the freight. And so during their times of competitive advantage right now, they're going to ship as much as they can. And then in the fall, when we have the advantage, we ship as much as we can. But you're both supplying and being driven by the same factors. Long-term production upside is high, especially in corn in Brazil and also Argentina, but more particularly Brazil. Brazil has become China's exporter of choice. This can be a good thing, this can be a bad thing, but we'll see what happens. This is relatively new to the market, and we'll see how geopolitics play into that as well. But that's a new thing for us to digest, and it's new for us to understand our role as backup soy supplier as opposed to primary. The 21-22 balance sheets are extremely sensitive to short-term weather. As we've seen, the numbers this morning continues to drop. The weather is not typically improved, so we're going to watch that with a very sharp eye. Every hourly report that comes out is moving this market around, and the market's going to continue to focus on that. Overall, the supply scare, the demand-driven market to get to where we are today, and now this potential supply scare from South America, it may be real, but it feels potentially a little overdone with the U.S. to start planting beans within the next few weeks. Southern beans will start to get planted, and we still have the opportunity to make adjustments to quell balance sheet problems if in fact they come up from South American weather. So we still have the U.S. crop behind it to fix a problem if we were to have. On to biofuels. Ethanol demand. So we've really seen a plateau of ethanol demand. We hit the E10 and then the E15 blend wall. We really saw no more reason to blend additional feedstocks. And so we've gotten to this point where 5 billion bushels of corn is about all we really need to supply the oil market with what they need. However, biofuels are huge benefactors in high crude oil environments. And obviously we're in a very high crude oil environment. So anytime you can blend lower price ethanol into a higher price gasoline, margins are going to improve, production is going to increase. And additionally, on top of that, we have corn oil. So corn oil, what is that doing we'll get into a little bit more in renewable diesel, but corn oil is adding significant bottom line margin to these ethanol plants now. So it's not as important what ethanol price is or DDG's price, but what is corn oil price? And that is a new mover as we go into the next couple of years with some new biofuels that we see. On the right, you see the production efficiency of ethanol. We started around 2.75 back in 06, and we have grown incredibly to get to close to 3 gallons of ethanol per bushel of corn. From those I talked to in the industry, we are getting close to maxing out that conversion. So we don't see much more from a corn to ethanol conversion upside, but the downside is byproducts. So can you get more corn oil out of the DDG? Can you get more CO2? Those types of downstream products are what the focus is, seems to be from the ethanol from the ethanol space today, corn oil specifically. So this is the ethanol board crush. Wanted to talk about this just a little bit. What is the board crush? Very simple, quick indicator of the profitability of an ethanol plant. Very simply, this takes the price of ethanol and divides it by the price of corn. A number of different factors are not included in this. What natural gas is, what DDGs are, your local basis, pricing differentials for ethanol, debt service. It doesn't take into account any of those things, just your simple spot crush. And as we talked, this is the same time frame as my 3-year charts from earlier. But you were in a very difficult margin environment through 2020, and then we get into 2021. Oil starts to rally, and really on the back of the oil rally, the commodity rally, ethanol margins improve because ethanol becomes a better blend stock as crude continues to grow. So margins continue to grow, and what I think is really interesting is how fast these margin environments can be corrected. We have production ethanol. We have idle ethanol production. And did we ever start it to get that supply back to the market? And it took 5 months to get us to those margin highs and 1 month to get us back to break even. So it really is incredible how fast these margins can correct, but it's also amazing how high they can go, in the meantime when the market is tight. So just touch on renewable diesel versus biodiesel. They use similar feedstocks. It's oils, veg oils, fats, and greases, but it's a less capital intensive process. It's incredibly cheaper to build and incredibly cheaper to process. The fuel has a lower cloud point, which is better for cold weather handling properties, which we've known with biofuels has been a problem in the past, cold weather properties. So that's a big plus for it there. I think the biggest, most important thing about renewable diesel is that it can be transported by existing pipelines and infrastructure. It does not need its own independent pipes, tanks, storage infrastructure. It doesn't need any of it. You can use it in the current existing infrastructure. One of the biggest drawbacks to E85 or the problems with it is that it requires its own infrastructure. You need new pumps, new tanks, new everything to handle that fuel. Renewable diesel does not require anything like that. It can be used in the current infrastructure. And I think that specifically makes it a big deal in the short term of getting this feedstock into these plants. 2021-22 projected 365 million bushels, up 185% from last year. That number is going to continue to go. Trying to find. I had a note about additional soy capacity, but I'll get to it here in a minute. So yeah, let's talk about soybean crush. Very similar to ethanol crush, right? It's the board prices of soybean meal, soybean oil, and soybeans in a math calculation to see what you get out. The interesting thing about soybean meal crush is we find this to be much more accurate than your spot ethanol crush, just because you have both of your outputs, both soy oil and soy meal traded off the board can be added in. And another thing is the debt service on these plants virtually is zero. We don't think there's been a new soy plant of size built in the past 10 to 15 years. So most of these plants have really no debt. So that you don't have that piece of an operating expense. Another thing you'll see here is the 60 cent kind of variable cost line. That you do not see ethanol plants soy crush plants operating in environments below a 60 cent crush margin. And you really see the difference in a mandated market versus a not mandated market, right? Ethanol can trade at huge negative margins. Soy is not mandated and will not do that. So with ethanol, we saw it was corrected immediately, not immediately, but in a very short amount of time. We couldn't do that with soybeans. We don't have any more crush capacity. We hit capacity. So these margins are still there. Our internal, so they are going to build some new plants that have been mentioned in the news. Our internal estimates have us by the end of 2024, we could potentially see additional million bushels a day of soybean demand into this market. If you take 1 million bushels a day times 350 days a year average runtime, that's 350 million bushels. If you remember what our carryout is projected for this year, it's 350 million bushels. So we could wipe out carryout by the end of 2024. The effect that these additional plants will have on demand and that soy structure is going to be incredible as we build these plants. So key takeaways on biofuels here, obviously a huge benefactor in high crude price environments. But when you have high margins, it encourages high production, and they get fixed almost immediately. We do think renewable diesel is a game changer across the spectrum. We have not seen all the trickle down effects from this. And it really feels a lot like the food versus fuel debate that we ran into in 2006 with corn versus ethanol, right? Food versus fuel, but now instead of corn, it is soybeans and soybean oil. And really, anything in the feed or human space with edible fats or oils, both human and feed grade, really has a target on its back now as a potential feedstock for that demand. So it'll be really important to watch how the market digests the changes in fats and oils here moving forward. The last thing, sustainable aviation fuel. We've already hit gas, we hit diesel. Really difficult, from what I understand, to hit bunker freight, which is for your vessel freight. So what's up next? Air freight. So this is something that's really caught on in Europe, sustainable aviation fuel. They have very small blending requirements over there, but they are using it. This can be made from a corn ethanol plant. There's also a number of other ways to get to it. It can be made with fats and greases as well, but US is actively investigating this, and definitely think that this could be on the docket going forward as the government continues to put in mandates for biofuels across all sectors. Similar to biodiesel and renewable diesel, we're not sure yet how the sustainable aviation fuel works in with current infrastructure versus new infrastructure. Do you need new tanks or not? Obviously, that is a big piece of economics moving forward. Big takeaway from biofuels in general is that innovation is not sleeping in this space. There is constant improvement, constant innovation, and they are working towards the next thing. So we really need to keep an eye on it. We thought ethanol for a long time might be kind of a Band-Aid. It has been, but they keep putting Band-Aid after Band-Aid on top of that. So we really got to keep our eye on what these biofuels are doing, especially in a high crude oil environment or fossil fuel environment. So just to wrap up, a few things, what we're focusing on for 2022 and into 2023. The most important thing right here on the forefront is corn acres. We have incredibly wide ranges for both corn and soybeans, and if you look at those ranges, it opens a gauntlet of production scenarios for this coming year. So there's a lot of the target is moving, but it's moving on a really wide spectrum right now, which makes it difficult to predict where prices are going to go, and that's what leads volatility to be as high as it is right now. One of the things we're watching for acres, you got the Feb Ag Forum coming up here at the end of the month, and then the March WASDE, so some important reports there. Another thing with acres we keep a very close eye on are these input prices. Chemicals are tough to get, fertilizer through the roof, labor going to continue to be a struggle with inflation at the forefront here. So input price, cost of production, you've heard it a million times, the market doesn't care about your cost of production. In the short term, yes. In the long term, it certainly does. So it's something to keep an eye on here, and we'll talk about where that, trying to move that paradigm higher, going into the next couple of years. South American production, really need to know what they're going to have. I mean, we're dropping it every report. People on the ground down there really pessimistic about the size of the crop, but how do you know? You got to get to the end of harvest and see what you got. So you're definitely pricing in some premium to the actual size of the crop, but you won't know until you get to the end. The biggest problem with South America today and the issues there is not really in our 21-22, but in the 22-23 balance sheets. And as I kind of demonstrated earlier with the WASDE table, how that can flow into the next year and snowball onto each other, create dramatic moves in the following years. And that's what we really think will happen this summer with the 21-22 balance sheet and what that ends up doing to the 22-23 going forward. Biofuel demand, we're going to keep a very close eye on this. Obviously, in high crude oil environments, we're making money. So anytime you're making money, demand is high. Margins are still good. And then with the emergence of some of these other fuels, and I talk about the innovation in the space, you're going to continue to see new stuff coming out, turning what we classify as waste into non-waste usable product, a value stream or value add downstream. And lastly, one thing I want to hit on is volatile basis swings. So basis is a function of your local market, your local supply and demand, and your freight. And what we're seeing is with freight really shooting to the moon, becoming extremely volatile, it is exacerbating the effect on origin versus destination markets. So in an origin market, you are oversupplied. Your extra supply has to go to another market. In a destination market, you're undersupplied. So you need to get additional supplies from somewhere else. What we've seen with freight increasing is that origins are getting incredibly cheaper and destinations are getting incredibly more expensive because of the cost of freight. So as freight moves, I think you'll see bigger basis swings than you have in the past because your local supply and demand is becoming much more affected by that big freight piece. And lastly, new crop bids are historically high. New crop soybean bids are 20 or 30 cents higher in the Midwest than they've been the last 4 or 5 years. Is this the export market trying to get ahead of our new crop, thinking that the South American problems we're having right now is real and we're not going to be able to get enough from them? It's hard to say. It feels like it at this point, but you know, that can all turn in very quickly with some weather down in South America. So something to really keep an eye on are volatile swings in basis, and knowing what your local market is doing from a supply and demand standpoint is going to be important. Just to finish up with a few items, I really like to look back long term. This is a 30-year chart. Goes back to some ranges that I like to look at, 96 to 06. I don't remember the corn market in 96. All I remember is raising show steers and sitting down with my dad at the end of every month and having a very strict discussion on what the price of feed was. But don't really remember much about this range. But it was obvious, you know, it was a $1.80 to $2.50. You hit $3 one time, but that's really where you were for 10 years. And then all of a sudden we had ethanol come. Here comes ethanol, and all hell broke loose. How are we going to restructure? We had to recalculate the entire demand side of the equation to throw 3, 4, 5 billion bushels of demand into the balance sheet. So that obviously caused huge volatility from 06, 07. China got an opportunity to come in and they wanted to buy some grain. They obviously a huge impact there. Throw in the 2012 drought. I mean, we were just all over the place. So a number of years there, 06 to 12, basically 13, where we didn't really have a solid direction. It was just very volatile. But after the drought, we got production back in line. We had stabilized ethanol production and knew what that was, and it felt like we'd really brought in this new range. And for the past 5 years, 14 to 20, we had been $3 to $4.50. And that seemed like a comfortable range. Into March of 2020, COVID is here. It doesn't seem like we're going to get out of it, and then bang, and we march higher and we hit, you know, $8 corn. So my question is, where does this market go going forward? I typically, should have some animations. There we go. I typically think we're going to hit somewhere into this range. Now, the range that I drew here is for the next 10 years. I don't think this is going to be a 10-year range. But one thing to think about here, we tested $5 before it bounced up in this most recent bounce. I don't know if $5 is the real floor here. If you look back at the 96 and 14, the floor on 14 was still slightly below the high of 96. So if we did that and dropped our floor slightly below the highs of 20, you're back to that 450-ish range. So then your range is our new range, 450 to 650, something like that. So this is where I look for where's the next move? Where does the paradigm shift? Have we set this paradigm higher in this new channel, or are we going to revert lower back to the 1420 moves where it felt very comfortable? And I think the biggest factor in here is going to be inflation, and that's the problem that's keeping us inflated today, for lack of a better word. And until we solve that, I think you're going to be kind of at the higher end of the paradigm here. So. And lastly, we'll hit soybeans here. 30-year chart, nearly impossible to draw ranges on this one, or some time frames where we felt comfortable with supply and demand. So really the only thing I could do here, and takeaways I want to show are where we are today, hit 1590 today versus the length of this chart, and then just the range here. Just $14 range. Now, granted, you have to go back to the early 2000s to see $4 beans, but you don't have to go back very far to see $8 beans. So there is just incredible volatility in this market. We are at the high end of the ranges that we've seen. So it's a great opportunity to try to manage risk. So as a producer in these situations, I really like taking risk off the table for this year and for next year if I plan on planting corn and soybeans. If you are buying inputs at these prices, you absolutely, in my opinion, should be locking in new crop grain at these prices. I think that one of the biggest mistakes that we can see is guys that locked in $1,000 fertilizer and are turning around and selling $4 new crop corn when all of these acres go in and didn't hedge ahead of time. So one thing I think really important is to hedge ahead of time here. Take a little pieces, don't sell it all, but definitely take advantage of some of the rallies that we've seen. As a consumer, you really got to stay kind of hand to mouth. You got to stay in the front end and really expect for the high prices to cure high prices. They always have, and they certainly will. It's a waiting game. When can we get there? Inflation is not your friend, obviously. So you're going to have to make some tough decisions. We have seen opportunities from the user side of big margin opportunities. You can go out and lock in margins as a consumer of corn or soybeans. You just have to do it at the right time. So if you have those opportunities, I highly suggest doing them. If margins today are, say, $1 a bushel, and 3 months from now we're only 30 cents a bushel, I would suggest hedging some of the 30 cents a bushel too, because when you get there, that could be below zero. So hedge your forward margins as the market allows. You can't go broke hedging a margin. So always put those margins in your pocket. And I do think we're going to have to see some overall correction here in soybeans after we get into U.S. planting season. But from a seasonal perspective, it's a hard time to want to go short soy. So with that on soybeans, I think that's about all I have.
Okay, thank you very much, Zach. A reminder to the audience, if you go to the GoToWebinar control panel, there is a box for questions. Feel free to type in your questions into that box and I will ask them of Zach. We have a few that have come in. One is, we've all heard about the congestion, log jams, at container ports, particularly in the west coast of the U.S. Has grain and oilseed shipping seen the same difficulties as container shipping of goods has?
Absolutely, without a doubt. And I think one of the biggest things is it is taking them so long to get the goods that are coming in, the really, really high value goods that are coming in. They no longer want to mess with the grain to go back. It's more economical for them to take boxes back empty. So it was a huge struggle for grain exporters to get their hands on containers because they were just they needed to go back to China to get the next shipment to come. So absolutely, what turn times were a huge problem. And from our export container side, those guys will tell you they have never seen anything like it. And it was on the grain side as well. Good question.
So follow up to that, do you see that sort of inhibiting or dragging on grain and oilseed exports for this crop year?
I don't have the numbers in front of me on percentages of container exports, but they are completely dwarfed by our bulk exports. And that market has had really no issue moving the bulk product, as evidenced by the program we put through in 1920. We put a lot of stress on those facilities. We pulled more port facilities, that were sitting idle. We put those back into business, but we do have the ability to execute from a bulk perspective. So that's not nearly having the same problems as containers.
Okay. Question about biofuels. You mentioned the 5 billion bushel sort of ceiling on corn for ethanol, if I got that number right, and that it sort of keeps sort of hitting that ceiling and then fluctuating from there. What do you think about exports, particularly in a high oil price environment? Do you think there's potential to grow that?
Absolutely, a great question, and something I probably should have focused on more for this webinar, but that's definitely an angle. We have been working on ethanol to China for a number of years. We've heard rumors this fall that it was going to happen. I don't think it's happened, or at least happened in bulk, but that would open an incredible path line for ethanol and for additional production here, definitely.
Okay, so a question that's relevant, I think, both to producers of row crops as well as consumers of feed. In terms of like feed and grain markets, do you see more risk on the upside or on the downside? I mean, do you think prices are likely to rise more, or do you see more risk on the downside more, or is it just too hard to call?
There's a lot of things going into that. You want to look at time frame specifically, but in general, I think we're a little overpriced today, to be honest. You're at a seasonal point where weather premiums are at their absolute highest, and so we build in, both with South America and with the U.S., we build in these big weather premiums if we do happen to have a problem. So it's hard to bet on a weather issue or a supply issue. So in general, I'm generally bearish, kind of longer term. In the short term, though, I mean, we are, like I said, it's a seasonal market right now, and we are really fighting with this inflation thing and labor as well. And I think that's going to be a big driver of where these market prices are going to go, over the short term. There's just too much uncertainty in what labor costs are going to be and what inflation is going to do.
Okay. Question about fertilizer. Any relief in sight for the supply problems and the pricing of nutrients?
Yes, absolutely. So last week or the week before, even, I heard the first reports of bulk or wholesale fertilizer in the Gulf dropping. So that's the first we had seen that. We just haven't seen it at the retail level yet. Personally, what I believe is that the retailer owns a whole bunch of this high price stuff. You can replace it considerably cheaper from the wholesale market, but he's already got it priced high, and he needs to burn through that inventory before the prices at the retail level are going to go down. Personally, I think the prices in the spring are going to be considerably lower, as those guys are going to have to move that product. In the Northeast, I had a discussion the other day, may be in the best spot in the country as one of the last to plant, and let that kind of overflow of high price stuff just drop to the market when it has nowhere else to go. So I do see some relief there as we move forward into the spring, but it's tough to with the labor and inflation thing. I'm just concerned about anything going down.
Okay, well that answers our questions that we had. So I guess I'll turn it back to you for any final thoughts, and we'll wrap up.
Yeah, sure thing. Well, again, appreciate the time. It was great to be here. If anybody wants to reach out to me, I left my phone number and email address there. Feel free to call me or email me at any time. it was great to talk to you, and I hope we get to do a session again.
Great, and I will mention two things before we close. One is for row crops, both as producers as well as consumers of feed. Crop insurance and insurance type programs through USDA are extremely important for risk management. Farm Credit East has a division called Crop Growers that is focused on crop insurance and would be happy to talk to any producers, whether they're on the buy or sell side of grains and oilseeds, in managing your risk. I will also mention again our webinars page, farmcrediteast.com/webinars. That's where all our webinars, past, present, and future live. So you can go there and look for the recording to this, as well as announcements for upcoming webinars. And with that, I will sign off, and thank you very much for your time, Zach.
Thank you all. Have a great day.